Hi, this is Chris with Investors Underground. In today's video, I'm going to discuss liquidity traps. We'll take a look at what these are, the structure behind them, why they work, and how you can identify them in the future. A liquidity trap in its most simple form is a stock that had a big spike one day, it had a lot of volume come in, and then it's a stock that faded off for several days, the volume dried up, and then the volume comes back, the price comes back, and it breaks above the prior highs and has a squeeze out move. That's essentially what a liquidity trap setup is. So if we take a look on the screen here, this is an example of a liquidity trap on the stock INAB, which I recently traded. This stock has been beaten down for months. The volume has been almost non-existent and it's just been a slow bleed out for a long time until you had this big volume day right down here. And this is really the start or the defining characteristic of a liquidity trap beginning. You need to have a stock that has a very high and abnormally high volume day. Sometimes this is the highest volume day of the year or of the last several months, or sometimes it's the highest volume day that it's ever had. So we're looking for outlier volume on a stock. Now, to accompany that, we want a stock that has had a big run up. So sometimes these spike 50%, 100%, 200%. The percentage amounts vary, but they all have one thing in common, and that is that they have big volume and a big spike. And that's kind of what sets off the liquidity trap to start, or at least potentially sets it off, because we need to see a few other things come together before we can call this a true liquidity trap. So here's a closer look at that big volume day for INAB. This was a big spike for the stock, big volume day, and then it was followed by consolidation and the volume dropping dramatically. So a characteristic of liquidity traps is after that first volume day, you'll often see the volume drop by about 90% over the following days. This could be over 1, 2, 3, or 5 days. So you'll see the volume go from 20 million, and then it might go to 2 million, and then it might even go to a couple 100,000, which we'll see what happened on the next day. So here's a closer look at the INAB chart. So you can see this is that first day when it really ramped up, it had that big liquidity, and then it's consolidated and the volume dropped off. Now, the key defining characteristic of a liquidity trap is the liquidity. So take a look at the volume here. That was that 20 million share day, and then it's followed by minimal volume. So what happens is that you'll have on this first day, you'll have a lot of longs get into the stock, and you'll have a lot of shorts get into the stock too. So it's very crowded, there's lots of liquidity, and people size based on that liquidity. So if there's 20 million shares being traded, if someone wants to take a short position of 50,000 shares or 100,000 shares, they can do that and they can move in and out of the stock relatively easily. However, over the next couple of days on this fade off, once that volume drops off, they no longer have that ability to get out without moving the price. And so if you have shorts that are still in this stock, as it fades off, they might feel comfortable, but the volume is also dropping off. And so that's why you have a liquidity trap situation possibly forming, because you had a big volume day, you had lots of longs and shorts in the stock, then you have a slow trickle down of the price, and you have the liquidity dry up. And so now we come to the key day where a liquidity trap could potentially play out, and this is when it would get on our radar. So you can see on this day, the price started to tick up a little bit. I call this tension in the tape. And so what that means is that if there's shorts that are still in here from a couple of days ago, they probably don't want to keep hanging on to it as long as the price is just going sideways. So they might start to cover, or they might get some buy-ins from the broker. They might be forced to start covering. And so what happens is that you'll see this volume start to come back a little bit. And if that pushes the price up with that lower volume up to the highs, then you'll see the cover come in. So everyone who was short in this stock has an average somewhere in this range. And as it gets past that, that's when shorts will start to drop out, they'll cut out, and they'll start to cover their short position. And so one strategy for trading these is to wait for a stock to have a big move, a couple of days of consolidation, and really wait for that volume to come back in, for there to be tension in the tape, and then for it to move towards the highs of the first volume day. So the price right here was about 190. And as you can see on this day, towards the end of the day, the volume was ticking up, the price was ticking up. And once we got close to those highs, that's when it triggered and that big cover came in. And so all those people who were short, and they might have had 50,000 share short positions, 20,000 share, 100,000 share, they are no longer being patient with their covering. They're saying, this is going the wrong way, I need to get out. And so they all cover at once. And then you might have 1 million shares or 2 million shares come in, and that is the cover. And so that's kind of when most of the time liquidity traps will end, is when you have that short cover, that squeeze happen. That was the volume. That was the reason why it spiked. And so after that cover comes in and you see that volume drop off again, that's usually a sign that that liquidity trap has played out. So you had the big volume day here, you had the spike, and then you had several days of consolidation and the volume dropped off. Then you saw tension in the tape. It started to tick above VWAP. You started to see the volume come back in. And as it approached the first day highs, that's when you really start to get that panic cover. And so this will depend on the particular stock, but what I've noticed is that a lot of times the cover will be somewhat symmetrical to the amount that the stock sold off. And so in this case, many times the stock will sell off between 30% to 50% from the highs down to the consolidation period. And so once it starts to tick back up and once it triggers, many times you'll get a symmetrical move of 30 to 50% up here. And so I traded this stock. Nate put it on my radar, and as it was coming into the end of the day, I noticed the pattern. I knew it was a liquidity trap, and I knew that it was approaching those first day highs. So I got a position at 190 or 192, and as it squeezed, I was looking at the volume to keep me on track, and as it squeezed, I saw the symmetrical move up, and I exited around 235. And so from 192 to 235, I think it was a 22% gain in about 3 to 5 minutes. So these are really powerful concepts and powerful moves in a short period of time if you know what to look for. Of course, there are nuances with this kind of setup, and it can depend on the market conditions. It can depend on the size of the company. What I've noticed is that a lot of times these stocks are sub 100 million market cap when they really have these great liquidity moves, but I've seen it all the way up to several $100 million market caps. But usually you don't see this in very large cap stocks or even stocks that are over $1 billion market cap. And the reason is that with these stocks, the smaller ones, you'll have a lot of float rotation. And so a lot of times the entire value of the company is traded in that first day. And so you have a lot of new people in here, and that's when you want to get those shorts that are in there. They're comfortable, the volume drops off, then it ticks back up, it triggers here, has a symmetrical move, and it's not always going to be exactly symmetrical. So you want to make sure that as it's working, that you're moving up your stop or you're scaling out, or at least that's how I trade it. Again, these are not buy or sell recommendations. I'm not a financial advisor. These are just educational trade setups for your information. Just to recap, a liquidity trap is a stock that has a big spike, a big volume day, and then the stock comes down, it consolidates. It usually drops 30 to 50%. The volume drops by usually 90%. It might go from 20 million volume from that one day to 2 million, and then maybe to 500,000. And then it'll consolidate for a few days, and then the volume will come back up. You'll see that tension in the tape. It'll get above VWAP, and as it approaches the price, the highs from that first day, that's when it could trigger, and all those shorts that we're holding over are caught in a liquidity trap, and they have to cover at the same time while the liquidity is not there, and that causes the spike up. And that's really the spike to sell into to profit from this. So I hope that this has been useful for you, and I hope that you check out Investors Underground, where you have a lot of trading strategies and setups like this so that you can improve your own trading. Thank you.